Welcome to the jungle where the hippo is king and is just tearing it up and doing amazing things. And you would think I'm talking about the hippo on the screen right now and potentially Africa and all that kind of stuff. But one, I'm not an animal expert, and as you'll see from this video, nor am I a financial expert or advisor or anybody that you should be taking that advice that way. But I am talking about Hippo, and I am talking about the insurance company. And they, in my opinion, are king of the insurance industry jungle right now for homeowners insurance. So recently, Hippo just went through a SPAC. They are going to be publicly traded. They are publicly traded. And I wanted to share a little bit about what they told to their investors and kind of where they're at as a company, what my thoughts are on it as a broker myself and one of the original people working with Hippo, and just kind of take you through some thoughts on Hippo and what they got going on. So let's jump in. First, to kind of share with you is their management team. So you can see over on the left-hand side, two guys I'm not familiar with, to be honest with you, Reed and Michael, but they're running the reInvent. They're the ones taking care of the SPAC. Okay. Since I am not a hardcore stocks person, I'm more an insurance guy. I'm going to stick with the right side of the page and hope you're okay with that. Asif is an amazing guy. I had an opportunity in Chicago back about 4 or 5 years ago, maybe 6 years ago, where I got to do a speed dating event. And but it was for business people. And Asif and I got about 2 minutes together, I think maybe a minute and a half. And it was one of those, hey Matt, what do you got for me? I've been pitched all day. I said, hey, I got a lot of homeowners insurance. I work with this big real estate company. I think your company is perfect. We should do business. He was like, yep, here's my card. Let's go. He introduced me to Rick, the next guy over. Him and I chatted on the phone. Next thing you know, we were working with Hippo. We were one of the OG insurance brokers to start to write policies. At that time, you couldn't even go to a portal. We were doing it with like URL links and everything like that. Also, at that time, Hippo wasn't really known across the industry. And every time I posted about it, which I won't share today, I wasn't always the broker's most loved person. You know, I was kind of seen as the outlaw using the new insurtech company that's going to come steal all the broker's business. But as you'll see as we get into this, I don't think that's really the case anymore, or was it then? But I think people are starting to come around. So jumping into this, they got a $5 billion valuation, which is seems like everybody go through a SPAC, or I like to call it SPOC because maybe the whole Star Trek thing. And one of my team members always makes fun of me for that, but SPAC. And what I really want to jump into is there's always somebody better at, telling you about the valuations and everything like that. So I'm going to look at it from an insurance standpoint. They're getting a 4x multiple, almost a 4.5x multiple. And really in our industry, if you're not a big, large brokerage right now, I'm not really seeing too many people getting more than 1.5 to maybe 3x. That's my opinion. I promise you in the comments below, or, if this was on social media, I'd have every broker telling me, oh, I can get 5x or I did this. No, you didn't. Most of the time, it's going for that 2, 3x. But let's say for argument's sake, they are a bigger one, and getting 4 isn't that unrealistic. What is more a little bit interesting is they're going off of 2023 premium. Okay. So they're saying, hey, you're going to pay not only a 4x multiple, 4.5x multiple, but you're going to do it on something that we're not even going to do for, or where we're going to be in 2 years, very Tesla like, right? Getting the valuation before they have a car on the road. In this case, getting the valuation before they actually have these homes insured. Now, what I'm thinking is that there was probably a meeting of the minds there. They probably said, hey, we think in 2023 we'll be worth a 7 or 8x multiple at that time. We're going to let you get in now, and we're going to kind of find a middle ground. So you're going to let us have those higher numbers. We're going to give you a little bit of a break on the multiple, and that's how I think that negotiation went. That's my opinion. I could be way off, but I'm not upset about the 4x. I think that's totally fine. I'm not really that upset about even the future multiple, because the unique thing about insurance, and this is why I'm in the industry, is that we get paid on a thing called renewals. So if you take Apple, for example, and you were going to go buy Apple, the company, and you bought it for whatever, doesn't matter, and you're looking at the sales from 2021, you're like, oh, this is great. I bought it and this is sales. Well, you might not know this, but the sales that happen in 2021 when you buy it aren't not guaranteed. Like you don't get paid on them again in 2022. Starting January 1, 2022, you got to go sell the iPhone and the computer and all that stuff again, right? You got to keep going, come up with new things. Things that's cool with insurance is that if you sell $10 million in premium in 2021, and you keep those clients, which you'll probably see coming up here that they believe they're going to keep these clients for a long time. When you start January 1, 2022, you have $10 million in premium getting paid again. So when you do 10 million again in 2022, you now are getting paid on 20 million. So if you're going to buy a company at a future value at a higher multiple, I do like buying something that I know kind of where they at least have on the books already and kind of can multiply that out. And then also I'm buying something that's renewable, and I think that makes a lot of sense. Once again, it's why I'm in the industry and why I think our industry is, the best out there. So moving on. One of the things I pointed out, as I'll mention probably way too many times, I am not a stock expert. There's a lot of people out there that, will be able to explain valuations and stocks and when you should buy. And, I know buy the dip, and I know I like this company. I'm going to invest in it and hold it for a long term. That's me in a nutshell. But one thing I did notice here from a former founder and former owner, and a larger part of the company I'm with now, Obi, is that they have a 2-year lockup for the management team. And how I'm reading that is, heck yeah, right? If I was doing a deal and they told me, hey, Matt, we're going to lock you up for 2 years and you're not going to be able to cash in your stock, I'm saying, if I'm okay with that, I'm thinking, yeah, what do I care? I don't want to cash out now. I want to cash out 2 years plus from now, because we're going to be bigger and better. And I do believe that with Hippo. I think that they are a baby as it relates to the industry, of course. And I think you haven't seen anything yet with them. That's my opinion. I think that goes across the insurtech in general. I think it's just very much there. So I really like the lockup period. So for those of you who are watching this are into stocks and you're looking at wanting to invest, that's one of the things that's kind of led me towards that. So continuing on, they're talking about old carriers, legacy carriers, the State Farms, the Travelers, the USAs, the Allstate. And what they're saying is that it's difficult to purchase them. They have poor claims experience. There's no good touch points. And they're just basically bringing up why you shouldn't be with them right here. And then they're also wanting to just show the market share. And what they're showing is there's one player in State Farm that has almost 20%. The rest are all under 10 and kind of, I think they'll use the word here later, as scattered, right? So there's then hundreds of carriers that all have small pieces of the puzzle, right? Overall, 100 billion market. That means State Farm's got about 200 billion. Pretty interesting. From the evaluation we saw earlier, they're saying in 2023 that they're going to have a billion in written premium, so 1%. So far, all checking the boxes. Makes sense. Moving on, what are they going to do different, right? I'm not going to bore you with all the insurance stuff because, that just wouldn't be my style. But I do want to just touch on this real quick. They have what's called ongoing underwriting. Back in the day, even most recently, it was, insure a house, go out with your Polaroid camera or now your iPhone, take a picture front, back, left, right of the house, submit it to underwriter and call center, a few states over. They look it over and they say, hey, there's not a hole in it. Looks like a decent house. Okay, we'll write it. And then that client stays with them for, let's call it 8+ years, and no other inspections are ever done, right? So what can cause that is you could have not appropriate rates. You could be underinsured or overinsured as things are changing. Not many people that live in a house past a few years don't do something to update the house or increase the value, or just make the house better for themselves, whatever it is. And so that's what's cool about Hippo's process. They'll do ongoing, underwriting to continuously look. So if, in this example, if you added a pool, they're going to see that and they're going to be able to add liability for that. All of a sudden, also too, most people are like, oh, I don't want them to do ongoing underwriting because, they're going to increase my rates. Actually, probably not. Probably the opposite, right? The more they know about your home, I think that they can actually reduce the rate. If you think about it, if you called your friend up and they had to value anything based off a little bit of information or a lot, and you're wanting them to stake money, it's always like, hey, can you invest in this? And what does someone always say? Well, I need more info, right? Well, why do you need more info? It's because so I can be more secure about investing. And that's really what insurance is doing too. They're saying the more I know about the house, the better I can rate it, and potentially give you a better rate. And so therefore, with the ongoing underwriting, you'll see from this house, an updated roof could potentially, depending on the state and things like that, could give some discounts, which people like, right? So love that. They're also doing a lot. I'm not going to spend a lot of time on it, but they're doing things with providing monitoring kits and different technologies that you can plug by your hot water tank and your washer and dryer to detect water before something major happens, because our industry is very simple. There's two things, in my opinion, how you make money in insurance, right? Take away all the small things like, operations costs and like that, right? There's two main things. You're driving sales and bringing more customers in, and you're paying out less in claims, right? So this is their way of paying out less in claims by preventing them in general, right? And of course, as we can see from their valuation they're wanting to do, they think they're going to drive sales. So you do both and you're successful. And like I said, that's the very simple 101 version of insurance. There's probably a million agents and brokers out there that would give you a put you to sleep moment with telling you about how insurance makes money. That's my version. And I'll give you the Red Bull version, the real short thing. Moving on, as we talked about, 105 billion in annual premiums. There's only one person above 10. They're thinking that they can keep for 8+ years. I actually don't agree with that. I think that 8+ years is really tough. I see this industry for the legacy carriers like almost like 3 to 4 years. Maybe Hippo can get up in the 5, 6, but there's just too much ability to move, i.e., what Hippo stands for. Like, let's make it easy to switch. So if they get the 8+, then anybody that's invested in them is going to do really, really well, I think, right? Because like I said, it'll keep stacking, and that valuation isn't, 1 billion in premium in 2023, it's 2 billion, and then, you've doubled, right? So I had to guess, I'm saying 5 to 6 years, but they're going to, of course, drive this home because that's going to help their valuation. Moving on, they're going to talk about old versus new. I'm a tech enthusiast, but I can't code or know what a lot of these mean. So I'll say left screen is what they're saying the State Farm, all states, all them of the world are. They got legacy stacks, their customer supplied data, it's outdated pricing. And then on the right side, they're saying this is the Tesla, right? Where we have our own tech stack. We're using data instead of, gathering it from the client. Our pricing is, next generation, as they say. So, they're just kind of sharing, the difference. And how I'll sum it up is Titanic versus speedboat. Titanic, left side, gonna hit the iceberg. Speedboat, right around, right? So that'll make it simple for you. They're going to be nimble, faster, and I believe that's the era that we're in, and why I see them continuously taking market share. Moving on, they have kind of 3 routes. One is the direct to consumer, which works in the homeowners personal lines industry. Not overall a huge fan of it, of course. I'm more bigger on the second one because, one, broker myself. I've been a user, client, everything. As I mentioned before, I'm an OG of Hippo. We were one of the first. If I wasn't the first brokerage on Hippo, we were definitely a top 20, I would assume, on there. But we were in before they were getting all their valuations and all this amazing stuff they have going on. Agent model is very good. It's very simple. It's Tom Sawyer, right? So for those who don't know Tom Sawyer, he, and I'm going to butcher this for those who really know Tom Sawyer, but he got some guy to offer him $10 to paint a fence. He made it seem so cool and fun and having a good time and singing and dancing, which is Hippo is making it seem that way. Well, do your homeowner's insurance through us, right? A broker, put your client with us, right? And so he made it so fun that everybody coming by said, "Oh, I want to paint the fence too." And he started paying, 4 or 5 people to paint that fence $1 each. He pays out five, he makes five, and while they're all working and doing that fence and he's just collecting his five and paying out his five. And mind you, he didn't pay anything for any of that song and dance and fun stuff. He drove it there organically. Um, he's on to the next thing, the next partnership, finding the next fence and everything. And that's really what I think the agency model is for Hippo is that they're getting, I think I'm going to butcher this number, but I think that 85% of all homeowners insurance is controlled by a broker right now. And they're just saying, hey, start putting it from State Farm or Travelers to Hippo paper, right? And they only pay when that gets done. And I love that model. Partners, I'm all about partners. If you know me, that makes most sense. Find people who have access to what you're trying to sell, find a win-win, whether that's financial or you're able to help their business grow and you reduce marketing costs. And to me, that does help retention and it also helps your close ratio. So I love their models. I'm a big fan of more of the agent and the partners, but the direct to consumer makes sense. I just think that spending a lot of money on Google ads is just not my thing. So moving on. Most companies go this way, right? If you look at most carriers out there that have been around, they try to write everything, jack of all trades. Hippo says, no, thank you. We want to just go vertical within the space. They say, hey, let's make data king. Let's do everything around the homeowner's insurance that'll make rates better in our core product. But let's also get into some other things that just surround it. And I love that. Some of their peers are getting into pet insurance and next thing you know, they're doing boat insurance. And to me, that just signals like I'm not doing a great job at what my core, vertical is. Hippo is not the case. That's why I think they're the best in the insurtech space. Outside of OB, my company, I think we're number one. I think Hippo is number two. But since this video is on Hippo, we'll say best in the industry right now. Moving on, they're just talking about MGAs, basically, how you can write through. They're making commissions through agencies, carriers as a service. That's kind of the direct, and then their retention and is getting them their premiums. I'll let you all dive into the economic models. I'm not going to spend a lot of time on that. Diving into their numbers once again, you can see they were 405 million last year. They're wanting to do 500 million this year, 7, and then they're 1 billion. Unless someone can break that out for me as far as lead to quote to close and all that kind of stuff, which I'm not privy to those numbers. If someone had said, hey, can they do it? Yeah, I think they can, and I think they will. Bearing all the numbers, like I said, insurance is a very number centric. You tell me you have 100 leads, and I can tell you the quote to close to quote ratios, and it's pretty simple, and you can expand that. So I'm assuming that's what they did here, and 1% of the whole industry doesn't seem that crazy to me, especially with all the catalysts they have going on, the money, the spend, and the hype around them, plus a really good company. I would probably lean that they did better than lean that they would do worse. So that's that. Moving on, we talked about this a little bit. Low upfront marketing because they're doing a lot of partnerships and agents things. 60%. Actually, this number seems low as far as payment annually. Most homeowners, and this is why we spend a lot of time in the home space and the rental space, most are paid through what's called Escrow, which you may or may not be familiar with, but that is the fun little thing that your mortgage person can help you with, that everything gets paid out of Escrow and then you pay one monthly mortgage check. Okay, it's called Escrow. And most of the time the insurance is paid out of that, meaning the bank pays your insurance policy annual and then they add a monthly portion of that to your mortgage payment. Okay, so I actually was surprised that 60% was the mark. I would have thought that creeped into the 70s or 80s just due to how homeowners insurance is paid. So that's my thoughts on this here. Rolling in, they're saying their average is 1,200 in premium. Once again, I'm not sure where they're pulling that from. Insurance is kind of tough to, especially as you expand across the United States, to say what is average premium, because are you talking Florida or Texas, or are you talking Illinois, Indiana? There's a big difference. catastrophe zones and where you're located things. But sure, 1,200 sounds like a homeowner's regular rate. I can get into that. 8+ years. Once again, I'm a little lower. The only reason why I see them being able to have a longer average customer life than, let's say, the Roots or the Clear Cover, the other, like in the auto side of things, is the fact that Escrow, once again, a lot of clients aren't seeing their homeowner's payment just getting taken care of kind of from the bank. 1 out of 3 of my clients actually, when I say, who's your homeowner's insurance with, they'll actually say their bank. They're like, oh, it's with Chase or Wells Fargo. And it's like, oh, okay, well, no, it's probably with Travelers or State Farm, but you get the point. It's not hidden, but it's also not in front of you. What's in front is your auto insurance. And then you got Flo and the little Geico constantly telling you, 15 minutes of your time can save you 10%. And that's why I think the home is like this, and auto I'm nervous on. So once again, here they're saying 5.4x from what it costs to acquire the customer to the lifetime value. So, in all intents and purposes, not being a math person, but they gave a little haircut to the SPAC team at 4 based off that. Moving into the retention and the loss, I'm not going to talk about the loss too much because I don't think they've been around long enough to really have some numbers that I can get excited either way about. It's really hard on the home front to, you could not be in certain states or certain areas. I get that, but really it's harder to control the home losses because, you have these catastrophes like just what happened down in Texas. You have tornadoes, hurricanes, all these things that are a little bit harder. If you're a bad driver and you have a lot of tickets and accidents and I don't want to write you, that's pretty good. You know what I mean? Like you can differentiate a little bit. Uh, they've gone through some losses, but it's not like Katrina has, hit or something like that last year. So I'm going to be out on the loss conversation for a second and just kind of be neutral. Improving retention, looks like they're in the high 80s, 90s. I think that is pretty good. To be in the high 80%, 90% is like 1990 State Farm Office. So if you're anywhere not around that, that's really good, especially for a high growth company. You're just in our industry, how people come is how they leave. That is so true. So if you have just a few clients and you really baby them and bring them in on a great relationship, you're going to have a high retention. If you're wheeling and dealing in Google ads and this and that, and they're coming in like crazy, Google ads and different things like that might be able to take them out. So if they're able to continue this retention, that would be really good, I think. Last comparison, them, we talked about it a bunch. The Root, Metro Mile. Would I like to be the CEO of that company and have all the equity? And I see what they're doing on the stock. Sure, I know they got hit up a little bad today, but sure. If I had to pick my horse, as we probably know from my T-shirt and this video, I'm going with Hippo. But this kind of shows you a little bit of comparison. And so you look at, gross written premium, 1.1 compared to 2.1 with Root. But the interesting thing, right, is when you go down to retention, you have an 87. This is what I talked about, compared to a 33. So that's almost like, 2/3 less. Let's call my math close. So that means actually this isn't that impressive, right? Because realistically, that drops that down to less than Hippos, right? We would be at about 700, right? If you take into fact that they're within 1 year going to lose almost 70%. So when you're in insurance, you're for that. We want to be in that long game. So what Hippo's doing by writing, they're writing about about half, but they're keeping 50% more, right? So, and they're going to keep that over for 7 years. So if I'd rather write less, which is also probably a cost thing, right? And then keep more for a longer time. So I think those are some numbers that are actually interesting. I bet Hippo shares a lot on, you know, uh, you know, where they're at with the growth and how much they're going to bring in. But I'm looking at this number, and that is the most impressive to me. 87% retention for 7 years. That's where they're really going to have a big book of business, right? Look at their peers, 60s, 30s, one hit wonders. That's like having the "Hey, I just met you" song, and then you never hear from them again, right? It's one hit. So average premium, as you can see, homeowners is going to have the best premium too. Lemonade, this is where they get dominated because they love to write renters at $100 a year in premium. And this is where you get into the LTV and the CAC. I just like saying that word. I'll let my tech company worry about what that means, but I love the word CAC. But I'm going to go long-term value because that's more of an insurance term for me. And you can see 5.4x, and that is because they have an amazing retention ratio. And so when they say best in class insurtech, like I said, take away my company and Obi, I believe that is accurate. Last, you can see also where they have to go. So they're getting that thing today, and some of the people watching this from a stock tip standpoint, should I buy? What I will say is I've been bullish on this whole conversation. I think they're best in the industry. I think that their valuation is, I think, fair if they do hit those results, and I think that they can. And you can see what one of the other publicly traded companies is getting. So you can see upside from what will the market pay for, right? So I think that helps answer what I'm doing as far as an investment in this and what I think, and I'll let you take it from there. And with that said, I think that, to recap this, if I am a broker, I'm wanting to get a contract, I'm wanting to see what Hippo's about, I'm wanting to write with them, and I'm wanting to help my customers. They do pay very good commissions. I won't share the numbers because I think it might be different for different brokers in different states. If I am an investor, as far as the stock, I'm excited for it. I personally have quite a bit of equity within them. Right now, it's somewhere between $10 to $11 a share. Bearing it had something crazy happen while I was recording this. And then, last, just where I think they're going in the future is I think they're going to be one of, if not the biggest player in the insurance when we fast forward 10, 15, 20 years from now in the space. And myself and our company will continue to partner and work with them. And I think that Hippo is going to be the future of insurance or homeowners insurance. And thank you for watching.